Hello, guys. Once again, I welcome you back. So, I'm glad to bring you another episode. And today, I'm going to be addressing something really important. It's really based off the texts that I received from you guys over on Telegram regarding certain issues. So, I'm here to really compare forex pairs versus synthetic indices. And the main issue we're addressing today is whether do you really need a different strategy for each, and that's what I'm going to be addressing. So we want to see the differences, and then in the end, we shall see whether the differences between both really require a different strategy. I understand they're really different, but we want to really come down to, does it really require a different strategy? You get. So in today's episode, I really believe it's really going to give the pace for the for the coming episodes, because I've been not uploading for quite a long time, but I've been thinking of how I can better serve you guys, like to bring on the best content. So I'm really excited. Please stick around. You join, like you follow, and then feel free to be leaving comments. I really like your comments. So uh, for this example, you're going to be using Euro USD, like something really small, Euro USD, and then volatility 75 here. But then the main thing is the content that I'm going to bring out. So I really understand, just like if you go on, let's say, GBP USD, it's going to be its movements, like they're going to be different from a bit different from those of uh, of Euro USD. So like there's always a difference. You get, there's always a difference the way gold moves, but they may move in the same direction, but using different like ways of moving. You get, so that is the first thing. But now, before I go any further, we are going to start off with the major differences, like like as far as synthetic indices and uh, synthetic indices and forex pairs are concerned. So the first difference that I have found out, anyways, it's that forex. Like we start with forex, like forex USD. Forex, it follows real market conditions or movement. You get, there is real market movement. For instance, of the asset. For instance, now when we're on Euro USD, like on the exchange, you get, on the like on the foreign exchange market, like it's real. Really, this is what is really happening. The euro against the dollar, like it follows real market movement. You get. So for the price of the euro, for instance, it has just moved. We on M15, but it moved from this point to here. You get. Now that means that in the real market, you get, that is the real value. You get, like that's what people are valuing it to be. You get, so it can be affected by, let's say, someone placing, let's say, for instance, this is your, if someone places a strong order against the euro, you'll find that it will fall against the dollar. Or there is something really important. It's that if anything happens, for instance, I'm trying to simplify this, but if anything happens, for instance, in the eurozone, like in, let's say, Germany, or any European country, like any country that is in the EU, if something happens and then it negatively, like, let's say, for instance, if it negatively affects the economies of the countries they are in, it means that the euro will fall against the dollar. You get? But if anything good, let's say, happens to the countries in the European Union, and then it benefits the economy of those countries, you'll find that the euro will be gaining more. Or if anything happens, for instance, last week we had NFP, you get, and that's why we got this sharp move that you're seeing here. You get, we bought. Why? It's because they released the data that wasn't favoring the US economy. You get? So we could see that, we saw that the market moved, like the euro gained so much against the dollar. So it's tracking real market movements. Then if you go to synthetic indices, uh let's go here on volatility 75. Like, when you come on synthetic indices, here the difference is that These ones, it follows cryptographically generated movements or algorithmic movements. You get? Now let me explain that. And this is where people penalize deriv so much, because deriv is the one that provides these ones, volatility 75, the ones that I'm talking about, the synthetic indices. Now, in if you're trading volatility 75, it is not tracking any it's not a real world movement or a real market movement. You get? It is similar to, it's not even simulated, but it is cryptographically generated. It is an algorithm that generates the movements here. You get? But now, cryptographically, it means the code, it's let me say this. It means that the movements are not manipulated. You get? They do not manipulate behind the curtains. You get? So if you know about cryptography, like it can be visible to anyone if you do research. So they do not manipulate. By the way, one time, if you to realize, people who say that they've manipulated the synthetic indices are those people, if at all you've lost, you get. But if you're winning, then you will not talk about, let's say, they are manipulating the movements. You get? So just like if you come here on Euro USD, yes, you may win, you may lose, and then when you lose, you'll be like, the market is going against me. So for here, much as they are not real world movements, like in real time, they are cryptographically generated. Like, deriv does not manipulate them, but it is a code, it is an algorithm that they generated that generates these movements. You get? But then let me also address this. Deriv is not manipulating this. You get? That's why, by the way, if you carefully study, by the way, for me, one time, even now, I was in that camp that believes that they were manipulating, but trust me, it pushed me to go and really study hard and backtest so much. Trust me, these people follow principles, as we are going to see. You get? So that is the first difference. Now, the second difference is volume in the market. When you come to Forex, let's go back here to Forex. The volume in the market, you get? The volume in the market varies at certain times and at certain price points. You get? Now, let me explain that by illustrating. Let me put on the volume indicator here. You get? We are on M15. Now, you see, for Forex, you get, for, let's say, Euro USD, you get the volume or the volatility in the market, you get, it varies at certain times and at certain price points. You get? Now, this is what it means. Now you can see this volume thing. You get? Here the volume was low. You get? And most times during the Asian session, even today, it's not that. Yes, let me hide that. So this is what I want to illustrate to you. Now you can see here during the Asian session, you get, the volume was low. You get? And you can find that the market is moving slowly. You get? And then during the London session, it starts to pick up. You get? And let's say during the New York session, it really picks up. You get? So now here, when we reach a certain price point, sometimes, for instance, now when we come and then hit this price point, you can see we hit it and then, like, it moved aggressively. So here, the movement, you get, there are those times when, let's say, when they are going to release news, you get, you're going to find that the market moves so fast. You get? So here, the volume varies. You get? Now let's go to synthetic indices. You get? These ones have what we call a constant volatility. You get? Volatility 75 and the rest, boom and crash, they have what we call a constant volatility. And this means that, you get, if you put, it's only that there is no volume indicator on this the trading view for synthetic indices. By the this trading view is different from this one. You get? It's different. For this one, you go on tradingview.deriv.com. You go in the browser and type in tradingview.deriv.com. That's when you're going to find this trading view for deriv. You get? On the PC or even on the mobile phone. So what I was saying is that these ones have what we call a constant volatility. You get? So which means the volatility, if you put, let's say, if you put this volume indicator, if at all it was here also, if you put it, the bars are going to be like on at the same line. You get? For this one, you're going to go on a, let's say you're going to go on a MT5, MetaTrader 5, and then you put the volume indicator. You're going to find the bars are just equal. You get? They're just equal. Why? It's because for these ones have what we call a constant volatility. Now, those are the differences. Now, in my opinion, to me, I believe the differences have not made any much sense as far as you wanting to be profitable is concerned. I believe all of you, including me, what we are interested in is being profitable. Like, that's what we are interested in, trust me. Now, the differences do not matter so much. Now, we are going to look at the similarities. What I want us to learn about is that, or what I want us to pick, or what I want us to determine is, do we really require a different strategy when we are trading Forex, and maybe we require a different strategy when we are trading synthetic indices? Now, the similarities are here. Actually, I have one similarity, but with an explanation. They use similar principles to move, both of them. Like when you come to volatility 75 or Forex, you get, they use similar principles to move. And by the way, that's why I've told you this episode is going to be so key on the upcoming episodes. You get? I want to really be giving out content when, if at all you've understood properly what I've been addressing, when you can apply it on boom and crash, when you can apply it on range break, when you can apply it on Euro USD. Because for me, when I was learning, I didn't go for, let's say, synthetics alone, and what I understood is the basic principles. Like, if at all I you tell me anything, at the end of the day, what are you trying to mean? You get? I don't know what's wrong with my trading view. So that is it. So now it brings me to a very, very important thing. So for a given number of buyers, you get, I'm explaining, they use similar principles to move. Now this means for a given number of buyers, there must be an equal number of sellers and vice versa. You get? When you come here on Euro USD, you get, on Euro USD, the principle behind, for a given number of buyers, let's say, if at all people want to buy here at this point here that you're seeing here, if people want to buy, wait, let me use this. If people want to buy here, you get, there must be, if at all, there must be an equal, if let's say, if at all there are people buying here, there must be people willing to sell. You get? There must be people willing to sell. Now, for that one, I will not explain so much. You get? So, you're buying. So, from who? You ask yourself, from who? Then there must be someone selling. You get? But then, at the end of the day, the market moves. Now, let me explain further. Now, the same thing, if you come here, you get? If at all, um, by the this let me first go back on Forex a little bit. Now that's where the institutional strategy came in. Let's say these people who talk about SMC, even may talk about it. That's where SMC came in from. Why? It's that it would talk about people who are people behind the curtains that are buying for you. When you, let's say, if you're buying, who are those ones that are selling? Who are those ones that are able to provide with the market? For instance, if I told you bought from this place up to this place, which means they must pay you. The broker must pay you because you were profitable, you were in profits. But where is the broker getting money? It means someone you've been able, like someone was selling. You've been able to make profit, and then that's where there is a liquidity provider providing money for the one that you're going to take. Let me hope it's clear. You get? Now, for these ones, you get, for these ones, there are no large institutions that are playing part. You get, if you've heard of large institutions, let's say JP Morgan, that they are providing liquidity in the market. Here, there is no JP Morgan that is providing liquidity. There is no Goldman Sachs. There is nothing like that. It is Deriv that created a code. Now, for these ones, there is a constant volatility. So, which means if at all let's say you're buying here, it will be costing Deriv. You get, when you're profitable, you get, it will be costing Deriv. Deriv is the liquidity provider. You get, Deriv is the liquidity provider. So, which means basically what you need, you get, what you need, what you need is to understand the principle behind the movement. You get, they all use the similar principles to move. You get, now let me explain that further. Both follow the same supply and demand principles. So now this is the most important thing. You get, now these markets, you see the way they are moving. You get, for the market to, let's say, for instance, I have this zone, I had marked it already down here, the one that we're seeing here. You get, to me, it was a level of demand. You get, but now when I mark it as a level of demand, even if it was on Forex and I mark properly a level of demand, a proper level of demand, you get, now, there was the same way the market will leave this area, the same way the market reacts to a level of demand. A valid level of demand is where the market will come and tap into that level, and then it will buy. You get, likewise, if you've properly marked up areas or levels of demand and supply in synthetic indices or volatility 75, trust me, you're going to be profitable. You get, I believe, for someone who thinks that they are going to, if at all you can properly trade synthetic indices, you get, if you can properly trade synthetic indices and make profits, the same strategy or the same approach, if you've properly understood supply and demand and you're not gambling, let's say, let me buy here, if you're not gambling, trust me, if you come on USD, like it will be the same thing. You'll apply the same strategy and then you'll be profitable. You get, so now, for one to be consistently profitable, he or she should have the proper understanding of the basic principles behind the movement. You get, so which means this drives me to the overall aim of this video. It was to let you know that what you need is not a crack for, let's say, boom and crash. That's where they're going to hoodwink you from, or to lie to confuse you from, that this one is going to be specific on boom and crash. No, what you need is to have a basic understanding of supply and demand. You get, supply and demand, and I'm talking about basic. What do I mean by basic? Like, if you cannot understand, if you cannot do something simply, if you cannot explain it simply, then you don't understand it properly. So, supply and demand, let's say, let me just illustrate something here, for and it's going to drive by the content that I'll be bringing on in the later episodes. Now, if at all I bring in a video, you should be able at least to mechanically illustrate what I've talked about. Let's say if at all we move here, we come here, then we go back, and then the market has come. Let's say it is at this point. What do I do under what is this point as far as supply and demand is concerned? You get, for instance, if at all we come and then we break, let's say, below and close below, what does it mean? What does it relate to supply and demand if we break and close below? Or if at all we reach here and then we get a reversal in here, what does it mean? Basically, like, you have to have a basic understanding of supply and demand. I know supply and demand is a very, very, very wide topic, but at the end of the day, basically, what does it mean when you reach an area of supply? Let's say when you break an area of supply, what does it mean at the end of the day? You get? Because I believe supply and demand is going to be behind. It is key when someone is using a trend line strategy. It is going to be key when someone using an indicator based strategy. Supply and demand is going to be key. Apart from someone who is gambling, who is just placing orders by chance, of which by the this is non gambling, that is the only person. But behind any strategy, even someone using BTMM, you get, even someone using these volume indicators, supply and demand, like is the king. You get, supply and demand is king. You get, for instance, here volume here increased. We can see that there was a lot of volume. What does it relate to as far as supply and demand is concerned? You get? At least you can see a volume was increasing. For me, I had already marked this area as an area of demand. So if volume increases here, what does it mean? If I was buying here, then it means if volume is increasing when I'm already in my area of demand and I've bought, then I'll be profitable. You get? But if at all volume is reducing, uh, so now basically that's what I want to bring out is that you don't need just a specific crack for volatility 75. Trust me, if you have a crack for volatility 75, for it to be consistent, it's going to have a proper address as far as supply and demand is concerned. You get, as far as supply and demand is concerned. So for now, I wanted to bring out this because I'm tired of responding to guys, people asking for boom and crash strategy. You guys, you're going on boom and crash. You like hot things. It's because you've not you think Euro USD is a, let's say it's a lie, then you'll be like, let me try at volatility 75, maybe it's also a lie. Now for boom and crash, given that for it you can see that it has started to go, and then you take entries, you be there and you're praying for the spike not to happen. I know that's why by the people go for what we call boom and crash. It's because for it can start to print candles, and then maybe a spike is supposed to happen, then you take an entry, then you go into profits, then you close very fast. Trust me, there you're just playing around. You're just playing around. All you need is to understand supply and demand. If I tell you, they say, actually, by the way, let me conclude with this. In Before, when I was starting out, by the way, even on this channel there are some videos where I used to talk ill about indicators. That was, I think it's because I didn't know much. But I believe, and I've always told you that I take time to learn every day, Trust me, you guys. And at this level where I am, I've come to believe that everything in Forex works for as long as it goes to the first principles. And this video, it was inspired by one time I'm so fascinated by what Elon does, Elon Musk. I hope you guys know about him. But there is something behind the Cybertruck. They went back to the first principles. You get? They went back to the first principles. That's why it looks the way it is. They went back to the skeleton of the car. You get? They went back to the basics, and you can find that if at all they successfully bring on that car on the market, it's going to be cheaper than similar cars, like with the similar features. It's going to be cheaper. Why? It's because when they went back to first principles, they found out that people were making cars, huge cars, putting unnecessary things because others were doing them. You get? So please, you guys, you go back to first principles if you want to be profitable. You don't need a lot to be profitable. All you need is to go back to the basics. Like if at all someone talks for an hour, like the way I've talked here, I think like for 18 minutes now. If I talk for all that time, at the end of the day, what does it mean? Does it make any sense? If at all it doesn't make any sense, you rewatch. If at all still it doesn't make any sense, you comment down below that it doesn't make any sense. So for now, wish you the best and peace.